$12.3 billion. That's the weight sitting on the shoulders of Caesars Entertainment, a debt so massive it could fund entire cities, build airports, or buy hundreds of private jets. But instead, it's chained to a company that once defined the golden age of Las Vegas. Caesars isn't just in debt, it's drowning. The very empire that gave the world Caesar's Palace, the Flamingo, and Harrah's is now locked in a fight for financial survival. For years, the neon glow of the Strip masked the cracks beneath the surface. But in 2025, those cracks have split wide open. The question isn't just whether Caesars can pay off what it owes, it's whether Las Vegas itself can withstand what happens if it doesn't. In this episode, we'll break down how Caesars ended up buried under billions, where the money went, and why even selling off its most iconic assets might not be enough to save it. Because when a company this big starts to suffocate under its own success, the entire city feels the tremor. To understand Caesars' current crisis, we have to go back to the empire-building years when growth mattered more than caution. For decades, Caesars Entertainment, then Harrah's Entertainment, followed a single rule: expand at all costs. In the 2000s, it wasn't enough to own one or two casinos. Caesars wanted the Strip itself. The company began buying properties like the Flamingo, Paris Las Vegas, Planet Hollywood, and the Link. Each acquisition looked like a triumph. But behind the glamour, the bills started piling up. Then came 2008, and the global financial crash hit Vegas harder than almost anywhere else. With tourism collapsing and credit markets frozen, Caesars' empire suddenly became a burden. In 2015, the company filed for bankruptcy protection, emerging later with a new name but the same old hunger for expansion. When the pandemic struck in 2020, the debt mountain grew again. With casinos closed and revenues evaporating, Caesars borrowed more just to survive. And instead of slowing down afterward, it made its boldest move yet, acquiring William Hill, a British sports betting giant, for nearly $4 billion. That deal was supposed to secure Caesars' future in digital gambling. Instead, it locked them into even more debt at a time when interest rates were climbing fast. Now, in 2025, that mountain $12.3 billion high is shaking the very foundations of the company that once ruled Las Vegas. When the debt becomes unmanageable, companies have two options: grow their way out or start selling the crown jewels. Caesars chose the latter. In the past 2 years, the company has launched a series of asset sales to raise quick cash and keep lenders at bay. First to go was the World Series of Poker, one of the most prestigious brands in gaming. Then came the Link Promenade, a bustling entertainment district right on the Strip. Each sale brought in hundreds of millions, but in the grand scheme of $12.3 billion in debt, it was like pouring a glass of water on a wildfire. The company also sold off several non-core casinos in regional markets, hoping to slim down and focus on its flagship properties. But here's the paradox. Every time Caesars sells a property, it reduces potential revenue streams that could have helped pay off the debt in the first place. Even more worrying, the company's stock value has plummeted more than 50% in just 2 years, limiting its ability to issue new shares or attract investors. And because so much of its debt is tied to high interest rates, each quarter feels like running on a treadmill that's speeding up. To outsiders, these sales may look like strategy. To insiders, they feel like desperation, the slow dismantling of an empire just to stay alive for one more quarter. Debt alone isn't always fatal. What kills companies is the cost of carrying it, and for Caesars, that cost has exploded. When interest rates were near zero, borrowing billions felt harmless. The Strip was booming again after the pandemic, and investors were willing to believe in infinite growth. But by 2024, the Federal Reserve had raised rates to their highest level in decades. Suddenly, every dollar of Caesars' $12.3 billion debt came with heavier interest payments, hundreds of millions more every year just to service the loans. Inflation made things worse. Food, utilities, and labor costs at every Caesars property skyrocketed. The company raised room rates to compensate, but that backfired. Visitors began complaining that Vegas had lost its sense of value. As prices climbed, so did cancellations. Occupancy dropped, revenues dipped, and investors noticed. By mid-2025, Caesars stock was down nearly 30% for the year. Analysts downgraded the company's credit outlook to negative, citing unsustainable debt and weak cash flow. On Wall Street, whispers turned into warnings. If conditions don't improve, refinancing that debt could become nearly impossible. For shareholders, it's a nightmare. For management, it's a daily balancing act. Paying today's bills while praying tomorrow brings a rebound. And for Las Vegas, it's a reminder that the era of easy money that built the Strip's glittering empire might finally be over. Caesars' financial meltdown isn't just a corporate problem, it's a citywide warning. For decades, Las Vegas and Caesars Entertainment have been inseparable, two sides of the same glittering coin. When Caesars struggles, the Strip itself feels the tremor. Think of how deeply the company's presence runs. Caesars Palace alone employs thousands of workers, from dealers and chefs to hotel staff and security. Multiply that by the Flamingo, Harrah's, the Horseshoe, and others, and you get a workforce larger than many small towns. When revenues fall, hours are cut, bonuses disappear, and the ripple spreads through the entire Vegas economy. The company's debt crisis also chills new investment. Developers and financiers look to giants like Caesars as indicators of market health. If one of the Strip's largest operators is drowning in red ink, it sends a message: this city may not be the sure bet it used to be. Even tourism feels the effect. Visitors read headlines like "Caesars removed from S&P 500" and start questioning whether Vegas is still the powerhouse of fun and luxury it claims to be. The illusion of invincibility, that sense that Las Vegas can never fail, begins to crack. In short, Caesars' pain becomes Vegas's pain. And unless the city rethinks its reliance on a few corporate giants, it risks tying its future to an empire built on fragile foundations. Caesars management insists that the worst is temporary. In earnings calls and press releases, executives project calm. They speak of operational discipline, strategic asset optimization, and a strong event calendar for late 2025 and 2026. Behind those polished phrases lies a far more fragile reality. The company is in survival mode. Its immediate strategy is simple: cut costs, attract guests, and buy time. To lure visitors back, Caesars has rolled out a wave of promotions, discounted rooms, dining credits, free parking for locals, and partnerships with travel agencies to package cheaper stays. They've joined citywide campaigns like the fabulous 5-day sale, offering short bursts of value in hopes of rebuilding goodwill. On the operations side, Caesars has been renegotiating supplier contracts, delaying renovations, and freezing new hires. Every dollar saved helps pay the interest bill, but every cut also chips away at the guest experience. Fewer staff, longer lines, less sparkle. The real hope rests on conventions and major events: the Formula One Grand Prix, large tech expos, and the upcoming Super Bowl weekend. These can bring tens of thousands of high-spending visitors, temporarily lifting revenues and investor confidence. But short-term boosts won't fix a long-term problem. Unless Caesars reduces its debt, diversifies its income, and restores the sense of value that made Vegas irresistible, these efforts might simply delay the inevitable. The empire is fighting, but the house always wins, and sometimes, the house collapses under its own weight. The fall of Caesars didn't happen overnight. It was the result of a flawed business philosophy that worked brilliantly in boom times but collapsed under pressure. At its core, Caesars' strategy has always been built on scale and spending. Own more properties, attract more guests, and keep them inside the Caesars ecosystem: dining, gambling, shopping, sleeping, all under one brand. For years, it worked. But when markets shifted, this empire-wide approach became a trap. Unlike smaller boutique hotels that could quickly adapt to changing customer trends, Caesars' vast network of mega-resorts moved slowly. The company relied on volume over value, assuming that as long as people came to Vegas, they'd spend freely. But today's travelers are smarter, more selective, and more price-conscious. Add to that a lack of innovation. While competitors invested in tech-driven loyalty programs, eco-friendly facilities, and curated experiences, Caesars doubled down on traditional casino spending. The company underestimated how the post-pandemic generation would prioritize experience over extravagance. Another mistake? Overconfidence. Caesars believed the Strip's appeal was eternal, that tourists would tolerate higher prices, resort fees, and limited perks. Instead, that arrogance pushed visitors toward alternatives. The result is a company trapped by its own size, too big to pivot, too indebted to shrink. Caesars didn't just lose control of its balance sheet. It lost touch with the very spirit that once made Las Vegas magical. Every city has its breaking point, and for Las Vegas, Caesars Entertainment might be the warning sign flashing in red neon. But if there's one thing this city knows, it's how to reinvent itself. Caesars' survival now depends on something far more valuable than money: trust. The company needs to prove to visitors, investors, and locals that it understands what went wrong and is willing to change. That means rethinking pricing, cutting back on hidden fees, and creating genuine value again. Imagine a Vegas where resort fees disappear, where locals receive loyalty perks, and where even budget travelers feel like VIPs. That kind of shift could reignite the emotional connection that once defined the city. Financially, Caesars may still have options. Analysts suggest the company could restructure its debt, spin off some properties, or bring in new investors focused on long-term sustainability instead of short-term profit. But these moves require humility, something rare in an industry built on ego and excess. The truth is, Las Vegas doesn't need another new casino. It needs a new philosophy, one that values people over margins, experience over exploitation. Because if the city continues to squeeze every last dollar out of its guests, it risks losing the very magic that made them come in the first place. $12.3 billion in debt is more than a number, it's a symbol. A reminder that when greed outgrows gratitude, even the brightest lights can go dark.